Good day and welcome to the second in our series for the year ending December 2024. This is the asset market review, and that will mainly cover the period to the end of December, but we'll on occasion also do updates until more recently. Right, starting out with commodities. If you look, gold has obviously been, a fantastic performer, and obviously silver along with it. If you look over 5 years, the metal's up 73 and silver up 62%. Looking at some of the other precious metals, palladium and platinum, looks a lot less inspiring. And then if you look the more recent past, for example, iron ore, which tends to be quite volatile, on a 1 year view down 24%, but still over 5 years up 13. And as we've discussed before, the problem is 13% is insufficient to actually compensate for the inflation pressure that miners have been experiencing. Copper generally quite solid, although the more recent past has been a little bit weaker if you look at the last 3 to 6 months. So a very mixed bag. Oil, of course, on a 1 year view, actually quite good news in large part for the global economy because of the inflation effect that introduces, but also being quite volatile over a 3-5 year period as well. So on balance of arguments, we would say that commodity prices probably slightly better, but the PGMs, the platinum group metals, are obviously disappointing. Moving then on to currencies, and we've got both the rand and the dollar, because sometimes when you sort of doing just a rand versus the dollar, you miss some of the movements in the dollar itself. So maybe starting with that's the two columns on the right hand side. If you look, the dollar from where it was a year ago against sterling, up a little bit, and over 3 and 5 years as well, sort of 8 and 6% respectively, and pretty much across the board. The dollar obviously has been the beneficiary of interest rates and superior growth relative to what you've seen, for example, out of the US and the Eurozone. The dollar actually has gained a little bit more against the euro in quite a few of those time periods. Then looking at the rand, it's the four on the left, 4 columns on the left. This was frank, we're not really going to worry about too much, but if you look rand dollar from a year ago, we've lost about 3%, but over 6 months, similar sort of 4%. But if you look at the rand against the euro, virtually flat on a 6-month view, and we're actually up over a 1 year view, and that again just sort of points to euro weakness relative to dollar. And but unfortunately, if you look, it's sort of 3 and 5 years, the rand obviously, or for the comparative, looking quite weak, or 19% against the euro and 21 against the pound. So the rand generally has been weaker over the last 3 to 5 years, but on balance of arguments, especially considering maybe much of the inflation differentials we've seen over the last year or two, probably holding its ground relatively well. And as you can see, they're also having gained ground against the Swiss franc. Right, I've just put Bitcoin up here because obviously quite a few people have an interest in it. Obviously, Trump and Musk are big proponents, or let's say keen supporters of cryptocurrency and digital coins. Combination of factors there seems to have taken it to 102. It's been quite volatile, sort of went powering through 100, subsequently came back. I think it's trying to find a new level. It's not something we invest in, frankly. I just don't understand, the appeal. But clearly there is a market, and more people obviously looking to add cryptocurrency to portfolios. We obviously looked at the table on the rand against the dollar. This is a chart, and as you can see, we often say this, the rand doesn't go up and down in straight lines. It vacillates quite a bit. And often what you find, for example, if you look at that sell-off in up to 2016, then you spend years recovering that lost ground, then you again get a blow-off. 2020, of course, was the COVID-inspired sell-off. And then again, you see 3-4 years of fighting back. And I'd argue the rand was actually in that strengthening phase late last year, and then obviously with the Trump victory, it caused a little bit of anxiety around emerging economies, particularly. Yeah, so that caused a little bit of a sell-off. So back into the mid 18s. But yeah, it does feel as though the rand actually wants to go a little bit better. All right, then having a look at bonds. We don't want to delve too much into them, but always important. And as you will see, yields have moved up quite a bit, and that just creates a slightly more attractive environment. So, if you've got inflation running at 2 and suddenly you can get 4 or 5% on long dated treasuries, and you're happy with the counterparty risk and you're happy with the interest rate risk, it's a lot more appealing than it was maybe 5 years ago when yields were 2% or 3% on long dated paper. Inflation was high, and yeah, so clearly bonds have moved a little bit higher. And we've said this before, and we say again that with yields at 4.5–5% on medium to long dated paper in the US, UK, obviously nowhere near that in Europe, but that looks a lot more appealing than when you were trying to buy these things, when interest rates were low and the outlook was clearly for probably rates and bond yields to move higher. So looking at the US 10-year, you can see, obviously got really, really strong this is just the 10-year that we've got up here. You can see, yields got compressed to well under 1%. Obviously, the duration didn't hurt you too much over that 5-year period, but in longer dated paper, you would have really got hurt, as you'll see in a minute when we look at the price charts. So it looks as though the bond market, as we said, actually in the big picture, it looks as though US bond yields are somewhat range bound, maybe 4.25 to 5 or a little bit below that. Kind of those push-pull effects, as we discussed. What's quite interesting, and it's a slightly messy graph, but rather than doing the time series, sort of the 3 months ago, 6 months ago, and a year ago, we thought we'd actually show what the yield curves look like. Obviously, the indices are index levels are slightly different. So in 2023, that low point on the y-axis is 3.6, whereas it's 4.2. But you can see short-dated yields or short-term yields have come down quite sharply from 5.5% down to 4.5%. And very importantly, of course, as well, is the yield curve, which was actually quite inverted, as you can see in December of 23, has now normalized. So the short end of the curve, those yields have come down by, call it 100 basis points or thereabouts. But if you look at the 20-year, which has gone from a little over 4% to almost 5%, is a full 80–90 basis points increase in those bond yields. And as you can see also, in the medium end of the curve and throughout the curve, not just 20 and 30-year, those yields have actually moved up quite significantly. And all of that leads us to, some of the pain that has been taken in global bond portfolios, from those ridiculous levels in 2020 where everybody was just panicking and it was a case of, buy US treasuries at all costs. You've gone from an index level of 22, all the way down. You would have, lost a hell of a lot of capital because of obviously the tilt towards longer dated paper. But it feels to us as though, now you've got a fighting chance of making a little bit of capital return. Obviously quite contingent on what happens around Trumponomics, but yeah, it just feels like now with yields on the longer end at 4.5%, it makes more sense to be buying longer dated paper. But we have no doubt that it'll be a little bit bumpy, and a couple of investors are seeing, from maybe bond purchases and treasuries of 6 months ago or a year ago, you've seen a little bit of capital depreciation, but we do think that that's temporary. Right, then moving on to the Eurozone, where obviously yields are a lot lower, in large part anchored by one or two economies, particularly the likes of Germany. So you can see the 10-year there about 2.5, so almost half the level that it is in the US. And if you look at the prices there, it's also moved a lot less than in in the US. Looking to the UK, we spoke in the big picture about, the fact that the UK was feeling a little bit fragile. You can see it here in the 10-year chart, but it also is relevant when you look at the yield curve. And this is a slightly different chart. This obviously, shows you up to 50-year paper, which you can largely ignore. So sort of anything from 30 years, I think, is largely academic. But you can see from, the 12 months ago was the purple dotted line. You've seen those yields, kick up significantly from, 4.5% to, 5.3. So a very significant ratchet up. The whole yield curve, basically, the shape is the same. It's just the whole yield curve is actually ratcheted up. And that, I think, is, as we discussed in the big picture, it's sort of a reflection of the anxiety that the market has with the new administration in the UK. And then also just looking at bond prices, you can see they're really in the doldrums. Probably maybe a little bit more optionality or upside potential here in UK bonds than in US bonds, but it does come with a health warning because of the Labour government's commitment to spending in some programs. So both US and UK treasuries actually looking mildly attractive, but more so from a yield pickup because cash yields have compressed so much. All right, then on to local bonds. They've actually been quite volatile all the way back to 2020 when we were sitting, with the 10-year probably around 8%. Got pushed all the way up with a variety of local political events and some external shocks, to almost 11.5. You've seen it fight its way all the way back to, just over 9%. So a nice rally, a nice recovery. And you can see it then also in the yield curve where, again, the purple line is where we were a year ago. So if you go out to the 20-year mark, you're looking at yields then probably of about 12.25%. Currently a little bit around about 11.75 if memory serves. So, our bond yield curve shape has largely remained, but it's actually just ratcheted down. So ironically, exactly the opposite of what we saw in the UK. And this makes a lot of sense, in terms of what we spoke of in the big picture, where it looks as though spending is being reined in a little bit. Doesn't look like debt is going to be too much of a problem in South Africa because of new issuances. And then also, of course, inflation has been not very different from what we've seen elsewhere. So the bond yield curve in South Africa is looking a lot better. And also because you just got the feeling maybe 6 months ago there was a little bit too much pessimism around ahead of the GNU. And then bond prices in South Africa obviously have also recovered very, very nicely. So if memory serves on the Govie over the last sort of 6 months, you're probably up 8% or thereabouts, and that's just on capital gain. All right, then moving on to equities, we're obviously going to start with global equities. And we've done things as usual, just sort of unpacking the recent performance, but then we've also just added a little bit in terms of what some of the bigger constituent parts and the industry allocations are in some of these indices. So as you can see there, the S&P and the NASDAQ on a one-year view had a good time, up in the mid-20s, but the Dow lagging only up about 13%, and the broader-based Russell actually quite disappointing at 10%. We'll talk in a minute about the Magnificent Seven and the effect that AI and technology has had, but for now you can just sort of take it as read that it's really a function of a handful of stocks really driving the performance. If you look at the FTSE on a one-year view, it's up 6%. It's it's back in record territory, which is encouraging. But as you'll see in a minute, if you look over a 5-year period, the performance has been very, very disappointing. Stocks equally only up 5% on a one-year view, not spectacular, and over 6 months actually down 4%. So you get the feeling that Europe is looking a lot more circumspect than the US, but the US itself is being powered by really just a handful of shares in one sector in particular. Then looking into Asia, you see, the CSI recovering quite nicely, up 15%. That was quite encouraging to see, and the Hang Seng a little bit better than that, up 18%. Short term, like Europe, been a little bit volatile and weak, where it's down about 2% on a 1 year view. Then looking forward to the longer term performances, the 3 year not too different for the S&P. 5 year though, you can see the effect of the Nasdaq being 140% up versus 82 on the S&P, and if you come down to the Russell, for example, up only 34%, and that gives you kind of an average in the middle, I suppose, between the Russell and the S&P, with the Dow up around 49%. Again, as I was just saying, FTSE 100 only up 8% over 5 years. Europe doing a whole lot better, up 27% over 5 years, but a similar sort of performance from the FTSE and the stocks, which is Europe, obviously, over a 3 year view. China on a 3 year view has been very weak, and it's also down, but not massively over 5 years. But the Hang Seng in Hong Kong obviously bearing the brunt of that negativity, down 30%, quite incredible, over 5 years. All right, so those are the static performances, but always useful to have a look at where things have come from. I suppose, maybe it would have been useful to rather show 5 year performances, but in quite a few of these indices, particularly the likes of the CSI and the FTSE, it's actually nice to see the longer history. So if you like, really just mentally zoom in from 2020, as you can see after the sell-off, you can see the S&P 500 has run very, very hard. We thought maybe just worthwhile to once again unpack how the S&P has been impacted by AI. And what we've got on the left-hand side there is effectively the top 7, the biggest 7 shares that in terms of weightings in the S&P 500 over a long period of time, going back to 1995. And you can see on average probably around 15%. So the top 7 shares would have accounted for about 15% of the weighting. You can see that's now up to about 33%. You can see the weightings there, the top holdings: Apple, Nvidia, Microsoft, Amazon, Meta, Tesla, etc. Information technology, as you can see there, representing 33%. Financials actually dwarfed in comparison with just 13%. Consumer discretionary, and you just have to apply your mind to how big that universe is and how many powerhouse companies there are, only representing 11%, and you can see industrials there all the way down at 8%. So it just gives you an idea of the extent to which technology has run and has become such a very, very important part of the S&P 500. And frankly, one of the reasons why we're actually a little bit anxious about the S&P itself, not all the constituents, just really the handful of shares, and we'll show you in 1 second why. And then obviously the Nasdaq, that slope from 2023 has just been spectacular. Obviously companies like Nvidia have maybe justified, the rally, given the strong momentum and the geared nature to AI, up until DeepSeek obviously came onto the scene, although we'll see how that plays out. But a lot of companies have been, sort of, let's call them peripheral beneficiaries, have been taken along in this AI slipstream. And I think that's what worries us. We think that maybe that's a little overcooked. Particularly if DeepSeek is right, and the US and all the money that's been spent on AI in the US proves to have been almost excessive. Then just having a quick look at a busy chart, I apologize. Looking at the Magnificent 7 stock performances in 2024, Nvidia is still up an incredible 170%, but quite a few of the others, the likes of Microsoft, have given back a fair amount. Apple also. These are the performances up to 2024. Obviously, we've had a little bit of weakness, after the DeepSeek news. But in large part, a lot of those more geared AI players have actually recovered quite a lot of the losses. What we really want to show here is not really the performance so much as the thing that worries us, which is if you look at the trailing on the left-hand side, that very busy table. So the red bars effectively are the Magnificent 7. You can see at the top the trailing price earnings multiple 43, and then in the column next to it you've got the forward 1 year forward earnings price earnings multiple 37. So I think coming from 43.6 to 37.2, our anxiety is there's not enough earnings growth in these companies, particularly those that are not like a Nvidia where there's almost leveraged exposure to AI. The companies like Apple and Microsoft and Amazon, the business models are actually quite different, and they're unlikely to deliver the kind of earnings growth that is necessary to unravel those PEs. So really that's what worries us. And you can also just see some comparatives in terms of the PE ratios on various indices and companies and countries, obviously. I think there's, in our mind, quite a lot of anxiety about the impact that AI could have on the mood, particularly towards the S&P 500. All right, then moving on, the FTSE 100, as we said, we should have popped a bottle of champagne quite recently when the FTSE went into record territory. But as you can see there, going back 10 years, it's really gone almost nowhere. It's come from a level of around 7,000 to 8.5. So been a very, very disappointing performer. What we thought we'd do just very quickly, for education purposes, I suppose, is just to have a look at what some of those index constituents are. If you look, for example, at the FTSE 100, if you look at sector breakdown, financials representing a little over 22%, consumer staples 17%, industrials 14%, healthcare 11%, energy, for example, is about 11%. So arguably a more balanced index than the S&P 500, where you had 33 followed by 13 and then sort of down to the 8. So I would argue maybe the FTSE 100 better balanced, although maybe arguably a little bit too much in financial, but it's not excessive. And then those little ticks there, the Shells and the HSBCs and Diageo and GSK, those are shares that we typically hold in offshore portfolios, and historically BAT was either owned directly or through its proxy Raynet over time. So hopefully that just helps to shape. Quite interestingly, the materials companies, the Glencores, the Rios, the Anglos, the BHPs, used to be quite significant components, but as those indices or that sector has battled, and some of the other sectors have actually gotten a little bit of their mojo back, it's sort of just rebalanced the relative importance of materials and miners in the UK. All right, then on to the Stocks 50, also pretty much in record territory. It's done a little bit better than, as we saw, than the FTSE 100, but looking back over 10 years from a level of about 3.5 to 4.5, it's hardly worthy of writing home about. So both the FTSE and the stocks have been disappointing over time. Again, just looking quickly at the constituents, I think what's different here, obviously, it's a pan-European index, so it covers the whole of Europe. It used to, before Brexit, used to incorporate UK listeds as well. As you can see there, the biggest constituents are French, with almost 40%. A lot of investors have a natural anxiety to investing in France, followed by Germany, which is actually quite a long way back, at 28%. Then the Netherlands obviously just happens to be a base for listings for quite a few companies, and then Italy, Spain are really quite peripheral. As you can see, the top holdings, ASML, very much a technology, a market leader in every way, followed by SAP, which gives you a fairly significant information technology weighting at about 17, as you can see there on the left-hand side. Financials also quite relevant at 20, or quite important at 20. Industrials at 18%. So again, relative to what we've seen, for example, in the S&P 500, weightings and constituents, both the stocks and the FTSE, a lot more balanced and a lot more spread out across sectors, but also in terms of less concentration risk. Then moving on to the CSI 300 in China, that chart says it all. Over a 10-year view, you basically haven't made money. Again, just looking at some of the constituents, and I think one of the one of the areas and one of the reasons we like the CSI 300 as an index rather than maybe some of the alternatives, there's obviously financial exposure in here, but in some of the indices the big banks particularly dominate, and we have some anxiety in inverted commas about the banking industry, knowing full well though that very small floats are actually owned by the market, and that ultimately you've got an effective put option and a funder of last resort in the Chinese central government. But what we like here, if you look financial, still 24%, but information technology is quite significant, just slightly behind that, followed by industrials, consumer staples, consumer discretionary. Some of the biggest holdings there, Kuei Chow, and you'll see it features as both number 1 and 3 at about 5%. It's a brewer / distiller, a giant and a good business. Maybe the valuation's a little bit rich, but that's good. If you look at contemporary Amperex or CATL, also got two structures there at about 3.5–4%. Obviously leading in terms of energy storage and materials and so forth. Ping An is a reasonable weighting at 1.5, but I think you can see quite a good spread. Companies like Medea and Ping An would all be known to many consumers and investors. But the interesting thing here is that the total of these top 10 holdings, understanding there's some duplication, is only 15%. So actually a very, very well diversified index, and you can see even the likes of materials and healthcare down here at sort of 7 and 5%. There's reasonable exposure to that. Then very quickly moving on to local equities, looking at the JSE top 40. We're just going to run through the charts over 10 years. As you can see, we've discussed this many times. The period from 2014 to 2020, the top 40 really didn't go anywhere in a hurry as a result of these push-pull forces. So you might have had resources doing well, financials doing poorly, or the other way around, or the industrial board doing better. But since 2020, obviously driven in large part by a couple of companies that have seen, as we've discussed, significant corporate restructurings, which have seen their relative weightings diminish, the likes of BHP, SAB Miller, Richemont, BHP. Arguably the index level has been somewhat artificially pegged, but I think it's fair to say when you look at the next three charts, which is the financial index, the Indy 25, and the resources index, where the performance has actually come from. So if you look at the financial index, if you look back to 2015, or you've got an index level of about 16,000. So the current level of, call it just over 20,000, very, very disappointing performance. But having said that, since the lows of 2020, really good return opportunities. But more recently, I think in large part driven by the Trump election victory, we've seen quite a big sell-off of SA Inc. And obviously financials are bearing a fairly significant brunt of that. Not that we're technical analysts, but it's quite interesting to see that index approaching that 200-day moving average, and you can see over time it has actually been quite a good predictor. So we see great value in the financial board, not only because it's underperformed, but we believe that you're going to get quite decent earnings momentum, NAV accumulation. For example, in the life offices, we think the discounts to intrinsic value will give you a catalyst. So we're quite comfortable that all things being equal, that the FINI should bounce off that, and we expect decent returns out of the financial board over the next year. Looking at the Resi, really disappointing. From 2020, obviously it was a difficult time. In early 2020, nice recovery up to 2022 when commodity prices were flying. And since then, it's been very, very disappointing. The index coming from over 85,000 down to under 60,000. And even on a 10-year view, you can see, it's hardly moved. It's probably up about 8,000 points. So clearly, if you look at the performance of the Aussie, the top 40, financials haven't delivered the performance. And in Resi hasn't delivered the performance, which really leaves the star performer to be the Indy 25. As we say, lots of moving parts over time. There was a time when SAB, Miller, Richemont, Naspers were massive components. Not so long ago, Naspers itself was 25% of the top 40, and you can imagine what weighting it had in the Indy 25. So a handful of counters have really helped to power this index forward, but it really has been a standout performer. And we'll go now into some of the tabular detail. All right, so as we just discussed, on a 1 year view, the top 40 up 7. It's lagging some of the broader based, the likes of the all share or the capped. Technology had a very good year. Obviously, after Tencent was added to the China military embargo list, it came back a little bit, but technology powered by Naspers up 33% in the year, and then small caps also having a good time, up 30% almost, and listed property up 21%. If you look at the more recent past, sort of the 3 month, I suppose almost capturing the US presidential elections, pretty much down across the board with some of the biggest weakness in basic materials. And you can see, the materials index, so effectively the resources counters, down 10%, 11% on a 3 month and a 1 year view. And telecoms also to December 24 were weak, down 12, but in the new year we've actually seen quite a nice performance from them. So really the standout performances also coming from banks on a 1 year view. Then looking slightly longer term, everything we were just talking about, the lackluster performance from basic materials with 8% gain on a 5 year view. Important to note that industrials is basically the local industrials, it's not the Indy 25, have also been disappointing, and listed property over 5 years also down 11%, and telecoms to December basically flat on a 5 year view. Obviously the banks and financials off that low base, courtesy of the COVID sell-off, have seen quite a nice run, with banks over 5 years up 45%, and that obviously together with the weightings of Naspers and Richemont helping to power the market in spite of this weakness that we've seen in some of the materials and local industrials. And then interestingly, small caps, which is a very obscure index, not very representative of what's quite a big universe, but also doing very well. And that's one of the reasons why we are fairly exposed to mid caps and small caps. Then ending off with listed property, not a sector we like very much. We still think that in spite of the improved mood around, that the challenges remain. If you look in South Africa, still lots of stock, difficult to grow occupancy rates, difficult to drive rental increases, plus administered prices, and a difficult retail environment. In spite of the fact that it's up very nicely, over 21% on a 1 year view, we don't think that, like others, that this is geared for the mother of all bull runs. We've got a SARB rate announcement tomorrow. That's on the 30th. We think they'll cut, but we hope for a total of 75 basis points in the first 6 to 8 months of this year. But there's not going to be awfully much help for the South African property scene. But interestingly, as you can see, that index level from around 650 10 years ago at 385, still over 10 years been very, very poor performer. And then finally, looking at global real estate, you're getting quite divergent views. You're getting some people, I saw JP Morgan making comments that they're quite bullish on global property. Others, ourselves included, are a little less inspired, although if I look at the fundamentals and I look at the yields and the interest rate outlook, I'm probably more inclined to allocate capital to other to global property rather than local property. But similar story, from 10 years ago, that index is still down, and we would probably still sit it out particularly if, as we discussed in the big picture, we do see inflation increasing in the US and elsewhere in the world courtesy of tariffs, because that'll really torpedo the possibility of further rate cuts. So in conclusion, it's been, I'd say you would say that the South African equity market did quite well. The US did well, other markets in record territory, but on a 5-year view looking a little bit dull. Bond yields looking fairly attractive, as long as the governments remain really relatively fiscally disciplined and manage the aggregate debt. So yeah, we are actually quietly optimistic on the South African equity market. We think that we're not keen right now on the highly valued sectors like the S&P, but we would argue, as you saw, some of those constituents in the FTSE, and even maybe some of the constituents in Europe and in China, are looking like they're offering opportunities. So we're quietly optimistic that in spite of all the challenges and all the noise that's going to happen from a political and a socio-economic point of view, that 2025 could be decent.